In this video of our multi-video seller series, we shall look at the Foreign Investment in Real Property Tax Act, or FIRPTA, and how it affects the buyer and the foreign national seller who is selling a home in the US. Here are 11 pieces of valuable information about this act and its implications on buyers and sellers in cases where the seller is a foreign national.
Number 1. What is FIRPTA? Before we look at its implications, let us first look at what exactly is FIRPTA. FIRPTA came into being in 1980 as a way of preventing foreign investors in real property from selling a property and not paying tax to the Inland Revenue Service, or IRS, on the capital gain. The purpose of this law is to facilitate accurate withholding and compliance for US tax purposes.
Number 2. To whom does FIRPTA apply? FIRPTA applies to all foreign persons, foreign partnerships and foreign corporations who have not made an election under Section 87(1) of the Internal Revenue Code to be treated as a domestic corporation and who are selling or transferring property located within the US. FIRPTA does not consider resident aliens to be foreign persons.
Number 3. What is the buyer's duty under this Act? FIRPTA puts the responsibility onto the buyer of a property owned by a foreign national investor to make sure that 15% of the purchase price is withheld at closing by the closing company. Prior to February 17, 2016, the amount was 10%. The FIRPTA tax can be looked upon as being a deposit on the tax due and may be refunded in part or in full to the seller after the IRS has reviewed and approved the seller's tax withholding certificate or tax return, depending on which way the seller decides to provide the relevant information to the IRS.
Number 4. Are there any exemptions? If the buyer is purchasing the home to use as his or her primary residence and the sales price is less than $300,000, then the need to withhold may be waived if the buyer is prepared to sign an affidavit to that effect prior to closing.
Number 5. What if the sales price exceeds $300,000? If the sales price is over $300,000 but no more than $1 million and the buyer plans to use it as a permanent residence, then the withholding amount is 10%. If the sales price is over $1 million, the full 15% withholding applies.
Number 6. Does FIRPTA apply to vacant land? FIRPTA does not apply to vacant land even if the buyer intends to build a home on the land. However, there are some restrictions for the buyer in that the buyer must be an individual rather than a partnership, trust or estate.
Number 7. Remitting the funds to the IRS. If the situation merits that 15% of the sales price must be withheld, then the funds will be handled in 2 distinct ways depending on how the seller decides to handle the FIRPTA requirement at closing. If the seller elects to submit a tax withholding certificate at closing, then the closing company may keep the 15% in their account until the IRS makes its determination. If the seller elects to try to reclaim the money in his or her next year's tax return, then the 15% must be sent to the IRS within 20 days of the closing date. Let us look a little more closely at these 2 seller options in situations when the buyer is not going to be signing the intent to reside affidavit.
Number 8. Seller's Option 1. The seller may decide to have the seller's accountant complete a tax withholding certificate and to send this to the IRS prior to closing, outlining the expenses the seller has had in the way of money spent in doing work on the home and money spent on the buying and selling processes. The IRS in turn will send a determination letter to the accountant once the IRS has reviewed the particulars of the tax withholding certificate, and this will outline how much of the 15% is to go to the IRS and how much is to be refunded to the seller. In the case of a tax withholding certificate being sent to the IRS, the closing company will keep the 15% in their account and not send it to the IRS at closing, so the funds are available when the tax determination letter is forwarded to the closing company by the accountant once received.
Number 9, tax withholding certificate. So what exactly is a tax withholding certificate? A withholding certificate can be looked upon as an application for a reduced withholding based on the capital gain of a sale instead of the selling price. If 15% of the sales price is more than the tax a seller will owe on the sale, then a withholding certificate is an ideal way to proceed. The IRS used to take on average about 6 weeks to send the determination letter, but since the COVID shutdown, this period has increased markedly, making it almost not worthwhile to send in the tax withholding certificate. Hopefully, with the passing of time, this delay will improve.
Number 10. Seller's Option 2. The other option is for the seller to simply wait until the year following the sale and submit a tax return for the year of the sale to recoup some or all of the withheld 15%. The tax return will report the sale and outline the capital gain, if any. Any overpayment will be refunded after the IRS has processed the return. If this option is selected, then the closing company will send the 15% directly to the IRS within 20 days of the closing.
Number 11. FIRPTA Accountant. Due to the large amount of money being withheld and the added complication of dealing with a large government body, the IRS, it behooves the seller to employ the services of an accountant well versed in dealing with FIRPTA tax withholding. The accountant will make sure that the seller's needs are best met at closing when it comes to the requirements under this Act. For sellers who do not already have an accountant to help them deal with FIRPTA, we are able to recommend several accountants.
Thanks for watching, and be sure to check out the rest of the videos in this seller series.